You are listening to The Vocal Technologist. Spoken tech for your ears.
Welcome back. You know, the pace of change in financial technology, it feels less like, well, evolution and maybe more like hyperdrive right now.
It really does. It's almost dizzying.
Yeah, and if you want to stay ahead of the curve, really track those foundational shifts in payments, AI, infrastructure, you need some serious synthesis. And, well, that's what we try to do here on The Vocal Technologist.
Exactly. We've been looking at a whole stack of material, and honestly, the takeaway seems pretty clear, the landscape right now. It's really defined by two big forces.
Okay, what are they?
First, you've got this rapid, almost aggressive integration of generative AI. It's everywhere.
Right.
And second, there's this intense, almost protocol-level competition to control your entire payment journey, whether you even realize it's happening or not.
Okay, let's unpack this for you then. Our mission today really is to look at how all the major players Google, Klarna, Stripe, even Jack Dorsey's Block, how they're using generative AI and these new payment rails to radically reshape, well, everything, from fraud detection right down to the next coffee you buy online. So let's jump straight into what's being called the agentic revolution. This is where the AI, it's no longer just advising, it's actually doing the transacting.
It really is the most significant shift, I think, maybe since mobile payments first hit. AI is moving way beyond just being, a helpful chatbot.
Yeah.
It's becoming a direct transactional agent capable of executing pretty complex financial tasks all on its own, autonomously.
And the results commercially are already looking pretty stunning. I mean, look at that strategic AI partnership between Klarna and Google Cloud.
Right.
They use generative media models, creating these dynamic lookbooks, really personalized shopping experiences. And in their early pilots, the results weren't just small upticks.
No, not at all.
We saw something like a 15% boost in app engagement, and get this, a staggering 50% increase in orders.
Yeah, that 50% jump is, that kind of conversion lift, it's basically the holy grail for e-commerce, isn't it? And they got there just by making the buying process feel, well, tailored and totally seamless. But it's not just about the flashy stuff, the personalization.
No, security's got to be key.
The security's fundamental, exactly. They're also using some really cutting-edge AI for fraud detection. Specifically, they're using something called graph neural networks.
Okay, graph neural networks. That sounds incredibly technical.
Yeah.
For you listening, maybe if you're not writing code today, what does a GNN actually do that's different from, say, the usual fraud models?
Well, okay, traditional models, they tend to look at individual data points, right? Like, was this transaction too big? Did the login come from a weird IP address? Stuff like that.
Sender checks, yeah.
Right. But graph neural networks, or GNNs, they look at the relationships between all those data points. They literally map out this network of interactions. You could almost call it the social graph of transactions. And that helps them detect these hidden connections, these patterns that might signal, say, a coordinated fraud ring, not just one single suspicious purchase. It's just much, much better at spotting those really sophisticated threats.
That makes a lot of sense, seeing the whole web, not just the single threads.
Exactly.
Okay, so if the AI is now transacting on its own, well, everyone needs to agree on the language the AI speaks when it wants to buy something, right? Which means, I guess, we've got this furious race now to set the commercial protocols.
That is, I think, the core competitive battle happening right now. We're seeing basically three major players trying to dictate how these AI agents talk to the checkout process.
Okay, who's involved?
Well, first you've got Stripe and OpenAI. They're pushing something called the Agentic Commerce Protocol, or ACP.
ACP.
And the huge implication here, the really big deal, is that ACP lets an AI agent, think something like ChatGPT, seamlessly shop and pay inside the chat conversation.
Whoa, so it skips the website entirely.
Completely bypasses the traditional merchant website.
Yeah. So Stripe's trying to own the conversation itself, making that chat interface the new storefront. But hang on, what's the trade-off there for the merchant? If the AI just skips their nice website, how do they keep brand loyalty? How do they control that user experience?
That's the multi-billion-dollar question right there. Meanwhile, you've got Visa. They're focusing more on owning the underlying clearance rail.
Right.
They launched the Trusted Agent Protocol, TAP. It's their foundational framework for letting AI agents handle payment transactions securely. They basically want to be the default layer of trust whenever an AI goes to pay for something.
Okay, so Stripe wants the conversation, Visa wants the payment trust layer. Who else?
And then Affirm, the buy now, pay later giant,
Yeah.
they're backing Google's play, which is called the Agent Payments Protocol, or AP2.
P2.
Got it. So yeah, you've got this race where Stripe's trying to set the rules for the shopping chat, Visa's making the rules for the actual payment clearance, and Google's trying to weave payment options right into its whole existing ecosystem.
Whoever wins gets to define the basic language of AI commerce. That's huge.
It really is. And look, this whole agentic revolution, it isn't just about you shopping online.
No.
No, the whole world of internal finance, especially things like enterprise resource planning, ERP systems, they're being radically overhauled by these agents too.
Right. We are seeing the big legacy systems respond, like NetSuite's Next update. They're putting conversational AI right into operational finance. They've got tools like Ask Oracle, where users can just, ask questions, natural language to query data, generate reports, visualize dashboards.
Yeah, just talk to it.
Exactly. And they also introduced SuiteAgent, which is for autonomous task execution right inside the ERP system.
The goal here really is to finally fight that historical chaos you see with payments data, where everything's fragmented, tons of manual data entry is still the norm.
Oh, yeah. Reconciliation nightmares.
Exactly.
Yeah.
Which raises a really important question. Can AI truly solve those historical pain points, like reconciliation?
Well, some of the newer, leaner players certainly think they can. We're seeing firms like Campfire, right? They just raised $65 million.
Yeah, big round.
And they're building AI-native ERP specifically for finance teams. They talk about using a proprietary large accounting model.
Great. A lamb.
A LAM, yeah. Specifically trained on financial flows, reconciliation logic.
Yeah.
And they claim it automates reconciliations with 95% accuracy.
That 95% number, that's the one that makes the legacy competitors pretty nervous.
I bet.
Because if you can automate that complex manual reconciliation work with that kind of accuracy, you're cutting huge labor costs.
Oh.
But always pause a bit at 95% accuracy in finance.
Why is that?
Well, banks, regulators, they operate on risk tolerance. That's often measured in 5 or 6 nines, 99.999%.
Higher bar?
Much higher. So the challenge for these new AI native systems isn't just automating the easy 95%, it's proving they're reliable. Totally reliable, and handling that tricky 5% of edge cases. That's where the real risk usually lies.
Absolutely. That last 5% is always the killer. Okay, so that transition from managing the AI agent to managing the actual money moving underneath, that feels like our next focus. We're shifting from who controls the agent to, who controls the rail the money actually runs on.
Right. And that aggressive fight to control the infrastructure, and maybe more importantly, cut out the intermediaries.
Yeah.
It's perfectly exemplified by Jack Dorsey's Block.
Ah, Block. Okay, they're launching this neighborhoods program. And this feels like a direct, really open declaration of war on traditional payment fees, doesn't it?
It absolutely is. They're letting small businesses run their own branded rewards and loyalty programs through Cash App.
Okay.
While paying only a 1% processing fee.
1%?
Yeah.
Yeah.
Just 1%. Now, to really appreciate how disruptive that is, you have to understand interchange fees.
Those are the standard card fees, right?
Exactly. The typical fees charged by the big networks like Visa and MasterCard, they usually hover around, say, 3% per transaction, give or take.
Yeah.
Those 3 percentage points, that's basically pure profit for that whole processing ecosystem. So by dropping their fee down to 1%, Block is essentially giving up 2/3 of that potential revenue.
Why would they do that?
To incentivize merchants like crazy to join their system. It strengthens the entire Block ecosystem, Cash App, Square, the whole thing.
Right. It's a strategic move. It tightens Block's grip from the actual point of sale machine all the way to your digital wallet on your phone. And it gives local businesses that kind of Starbucks-style loyalty edge without needing, massive internal tech teams.
Exactly. Now, moving away from those kinds of proprietary networks towards newer digital rails, we absolutely have to talk about stablecoins.
Ah, yes. Stablecoins.
They're rapidly moving out of the sort of crypto fringe and into mainstream financial infrastructure. This is where the really big money is starting to bet on the future of cross-border speed and efficiency.
Okay, like Stripe, for instance.
Yeah.
The platform that enables so much global e-commerce. They're rolling out stablecoin-based subscriptions now, right? It's in private preview, I think.
That's right. Supporting payments in USDC, specifically over the Base and Polygon blockchains, they clearly recognize that using stablecoins can enable really rapid global expansion for companies that need that instant liquidity across different borders.
Makes sense. And institutional interest seems to be absolutely surging. You pointed out this fierce, high-stakes bidding war for a stablecoin infrastructure firm called BVNK.
Yeah, BVNK, based in London. And reportedly, you've got Coinbase and MasterCard competing tooth and nail to buy them.
Wow. Coinbase and MasterCard.
Yeah, and the deal value is apparently somewhere between 1.5 and maybe 2.5 billion dollars.
Billion. That's huge. That potential valuation is massive. It would blow past Stripe's previous big deal, the Bridge acquisition, which was about $1.1 billion.
Exactly. It just underscores how critical this stablecoin infrastructure is becoming, both for legacy players like MasterCard and the crypto giants like Coinbase.
And why BVNK specifically?
Well, because BVNK already processes over $20 billion a year. They're clearly an established player, significant global payment rail already.
Got it. Okay, so while that's happening, the traditional network giants, they're not just sitting back, they're responding, right? Not just by trying to acquire companies, but by using AI to modernize their own existing systems.
Absolutely. Look at MasterCard's payment optimization platform, or POP.
POP, okay.
They're using all their network insights, plus AI, to proactively boost merchant approval rates. And in the early pilots, they're seeing lifts of like 9 to 15%.
9 to 15% increase in approvals. That's a phenomenal lift.
It really is. It's all about using those huge data sets they have, applying machine learning to optimize authorizations basically in real time.
Which means a smoother checkout for you, right? And it eliminates that incredibly frustrating moment when your card gets declined, even though you know you have the money.
Exactly. And Visa's also working on integrating payments deeper into business operations. Visa and a company called KNX, they're embedding Visa's virtual card capabilities directly into Oracle ERP systems, including NetSuite.
So automating supplier payments.
Yeah, and the reconciliation that goes with it. It's all aimed at killing off those fragmented manual processes and disconnected systems, especially in B2B payments.
Okay, let's maybe zoom out a bit now. Let's connect these tech trends to the broader market and even the geopolitical context. We've certainly seen some intense volatility lately. And looking at where strategic capital is being deployed, that often shows us where the big institutional money is really heading long term.
Well, we definitely witnessed a historic political shockwave in the crypto space just recently.
Yeah.
A massive $9.55 billion in crypto open interest just got wiped out.
$9.5 billion in one event.
Yeah, in a flash event. It happened right after President Trump announced the possibility of imposing 100% tariffs on Chinese imports.
Wow. Okay, so that announcement triggered a huge sell-off across digital assets.
Profound sell-off. Bitcoin and Ethereum led the plunge. They accounted for over $2.6 billion in liquidations just by themselves. It's just a really sobering reminder of how interconnected global policy and the digital asset market really are now.
Yeah, no kidding.
And what an event like this kind of implies, I think, is that the whole institutional adoption argument for assets like Bitcoin, which really relies on market stability and predictability, well, that gets immediately challenged by this kind of macroeconomic and geopolitical uncertainty.
Right.
These geopolitical shockwaves seem to translate instantly into asset liquidity crises in crypto, maybe unlike traditional asset classes that have more, built-in circuit breakers or speed bumps.
Interesting point. So looking at longer-term corporate strategy, we see some incumbents really doubling down on stability, perhaps in response, like JP Morgan Chase making this huge decade-long commitment with its security and resiliency initiative.
Yeah, that's a big one. They plan to invest up to $10 billion over 10 years.
$10 billion. Into what kind of companies?
Companies critical to U.S. interests. They're focusing on defense, frontier tech, think AI, quantum computing, and also energy technology.
Okay, so that's a really large-scale strategic play, trying to boost domestic innovation, production capacity in these critical sectors.
Exactly. And it stands in pretty stark contrast, actually, to the strategic challenge facing a lot of traditional regional banks right now, which is what some are calling the missed stablecoin opportunity.
Okay, explain that challenge. If stablecoins offer all this efficiency we talked about, why are banks potentially missing the boat?
Well, they basically risk watching FinTech companies, the big payment networks, and maybe the very large global banks, the GSIBs, take the lead in tokenization and building these new rails.
I see.
Banks could gain significant efficiencies, in their back office operations, and they could unlock totally new revenue streams through tokenized assets. But it seems like a combination of maybe regulatory hesitation and just slow modernization means they're falling behind the really aggressive market movers we discussed earlier, like the Stripes and Coinbases of the world.
Right, and yet we still see some market movers just defying the broader uncertainty, like Navan, which used to be Tribe Actions.
Mhm.
They're apparently pushing ahead with their IPO,
Yeah.
despite market volatility, even despite the recent U.S. government shutdown talk. And they're targeting a pretty hefty valuation, right? Like $6.45 billion.
Yeah, they used a specific SEC rule that basically lets filings automatically go effective. It just demonstrates that some companies, when they really believe their valuation and growth story are strong enough, they're willing to just kind of force their way through market uncertainty.
Okay, so let's try and bring this all back to you, the listener. What's the big picture here? FinTech today, it feels like a furious multi-front war.
It really does.
It's a race, isn't it? To build the fastest, most automated, and most sort of ecosystem-controlled payment experience possible, whether that's through these competing AI protocols, ACP versus TAP versus AP2,
Yeah.
or through proprietary low-fee networks like Block's Neighborhoods.
Yeah.
The objective, ultimately, it seems to be about controlling the transaction flow.
Absolutely. But, even while these protocols compete, the underlying trend toward more integration, maybe even shared infrastructure, that seems key too. It's often argued, for example, that open banking actually benefits traditional banks just as much as it benefits the fintech startups.
Ooh.
Well, because it essentially forces banks to modernize their legacy systems, and in doing so, gain a much deeper understanding of what their customers actually need and want.
Interesting take. And we see even the giants proving they aren't just waiting for outsiders to force their hand, right? Bank of America launched AskGPS.
That's right. AskGPS. It's a generative AI assistant specifically for their global payment solutions division.
And it sounds powerful, trained on thousands of internal documents.
Yeah, over 3,200 internal documents. And it now supports something like 40,000 clients in 29 different languages. It just illustrates that even the biggest incumbents are prioritizing building their own really robust in-house AI infrastructure. They're not waiting around.
Okay. So when you look at the whole picture then, you've got companies like Stripe and Visa spending billions to build the actual protocols for AI to shop for you seamlessly. It does raise one final kind of provocative question for you to maybe mull over.
Okay.
When that AI agent can just effortlessly choose a product, maybe even negotiate the price, and then pay for it using its preferred protocol, whether that's Google's AP2 or Stripe's ACP, who is the real customer in that transaction, is it you, the human, who gave the initial instruction? Or is it the AI itself, which is trained and optimized to execute that purchase based on the rules set by whoever owns the protocol?
That's a fascinating question to end on. Who really holds the power and the purse strings in an AI-driven economy? Something to think about?
Spoken Tech for your ears.